The market is officially crossing into the second half of 2026, leaving behind the speculative frenzy of the early 2020s in favor of a cautious, bifurcated landscape. This environment is anchored by a Federal Reserve that has held policy largely unchanged through the first 6 months of the year. With inflation hovering around 2.4%, financial conditions remain exceptionally tight for investors and developers alike. Construction inputs add to the pressure, currently sitting at levels more than 40% higher than their pre-2020 baseline. This debt maturity wall represents $1.5 trillion in commercial real estate loans that must be restructured or refinanced as we move into the second half of the year. High borrowing costs and expensive materials have removed the margin for error. Cheap money can no longer be used to hide the flaws in a bad deal. While some headlines suggest a total market collapse, the reality is more nuanced than a single unified crash. The monolithic market structure of the last decade has suddenly shattered into dozens of distinct, highly competing fragments. Because different asset classes are moving in opposite directions, generalized investment strategies have become ineffective. Capital is returning to the table, but it is focused and highly selective. Institutional and private credit sources are targeting premium assets, characterized by high credit tenants and long weighted average lease terms. The remaining months of 2026 will reward the educated capital that prioritizes specific asset selection over broad market momentum. To identify where this capital is moving, we use the Bifurcation Matrix. This model plots sectors based on their supply-demand balance and their overall liquidity. Retail has emerged as the surprise heavyweight champion of 2026, sitting firmly in the high-demand quadrant. This sector currently has the tightest vacancy rate in the industry, holding steady at approximately 5%. The strength is concentrated in neighborhood, grocery-anchored centers that serve essential local needs. Demand is also rising for experiential, open-air concepts that have successfully expanded into suburban markets. Because of this sustained consumer demand, retail rent growth is currently outpacing every other property type in commercial real estate. In contrast, the pandemic-era darlings, industrial and multifamily, are moving toward the oversupply quadrant of our matrix. These sectors are seeing the results of massive development cycles from previous years, finally delivering new inventory to the market simultaneously. For multifamily properties, this wave of new supply has caused rent growth to flatten across most major markets. Industrial vacancy rates are peaking right now in mid-2026, as available space finally catches up to tenant demand. Specialized facilities such as cold storage and advanced logistics hubs remain the primary exceptions to this trend. These sectors are undergoing a strictly mathematical normalization of supply and demand after years of hypergrowth. The office sector is now the most aggressively polarized segment of the market, with outcomes determined almost entirely by the quality of the asset. Class A properties in prime talent clusters are maintaining healthy leasing activity, while older Class B and C assets continue to lose tenants. For those aging properties, the only remaining options are adaptive reuse, residential conversion, or total capitulation. The hospitality sector faced a different challenge, starting the year with sluggish transaction volume due to high borrowing costs. However, operational fundamentals remained resilient, with occupancy levels stabilizing in the low 60% range. Strong metrics in average daily rate and revenue per available room have successfully preserved hotel asset values through this transition. As property values stabilize, buyers and sellers are finally able to agree on price, which is leading to a measurable increase in transaction volume. Strong operational management is the primary force driving transaction volume for the remainder of 2026. While many sectors are normalizing, developable land is seeing a hyper-focused surge in demand. This demand is driven exclusively by developers building AI data centers and advanced manufacturing facilities. However, looking at the utility map, it becomes clear that growth is hard-capped by physical limitations in our power grid and long utility delivery timelines. Severe zoning hurdles and massive grid capacity issues are extending project timelines by years in many high-demand regions. In this sector, the primary competitive advantage is securing utility approvals early, before the local power grid reaches its maximum capacity. Despite stabilizing fundamentals, the market still faces significant external headwinds that inject uncertainty into capital deployment. Geopolitical trade policies have resulted in 50% tariffs on essential building materials like steel and aluminum. These tariffs are actively squeezing development pipelines and reducing margins for new construction projects. At the same time, the persistent threat of federal government shutdowns continues to cloud the macroeconomic outlook. These volatile external pressures are driving smart capital away from speculative new builds and toward defensive, income-focused strategies. The financial reality of 2026 is that cap rate compression will no longer save a poorly managed asset. Returns for the remainder of the year will be strictly income-driven, based entirely on the performance of the asset. Success now requires a rigorous focus on operational execution, including realistic property improvement plans and nuanced market underwriting. Investors must prioritize defensive income streams and effective tenant retention to generate yield in this environment. The era of speculative momentum has ended. The second half of 2026 belongs to the operators who can underwrite and manage fundamental value.